Thanks for watching. If you like our channel, please subscribe now, then you will not miss any videos in the future. Ever wondered what makes Warren Buffett, one of the world's most successful investors, stand apart from the rest? It's his long-term perspective. Buffett, a titan in the investment world, is famous for his steadfast focus on the long game. He's not about quick wins or trying to time the market. Instead, he meticulously researches companies, grasps their business models, and patiently waits for the power of compounding to do its magic. Now, let's delve into the key principles of Buffett's long-term perspective. The first principle of Buffett's long-term perspective is a focus on value. Now, what does this mean? Well, just as a collector might scour flea markets and antique shops for hidden treasures, Warren Buffett seeks out companies that he believes are undervalued. But unlike a unique vintage record or a one-of-a-kind piece of art, the value of a company is not subjective. It can be measured, quantified, and compared. Buffett doesn't just look at a company's current market price. He dives deeper, analyzing its fundamentals, things like earnings, assets, liabilities, and growth potential. He wants to understand the company's real intrinsic value, which may be far more than what the market currently recognizes. Now, this doesn't mean that Buffett is simply looking for cheap stocks. There's a big difference between a cheap stock and an undervalued one. An undervalued company is like a diamond in the rough. It's worth more than its current price suggests. A cheap stock, on the other hand, may be priced low for a reason, perhaps because it's not a very good business to begin with. Buffett is not interested in such companies. He's looking for quality businesses that, for one reason or another, are trading at a discount to their true value. By buying these companies and holding on to them, Buffett aims to profit when the market finally recognizes their true worth. That's how Buffett's focus on value plays a crucial role in his long-term investment strategy. The second principle revolves around business quality. When we delve into the mind of Warren Buffett, we discover an uncompromising focus on the caliber of businesses he invests in. Buffett isn't interested in just any business. He's after those with competitive advantages that stand the test of time. Picture this: a business with a brand so strong, it's synonymous with the product it sells. Think of a company with such high barriers to entry that competitors can't easily step into its market. These are the types of businesses that pique Buffett's interest. They're like fortresses, resilient in the face of economic storms and market fluctuations, but the allure doesn't stop at just competitive advantages. Buffett also looks for companies with a successful track record. He's not interested in flavor-of-the-month companies that might be here today and gone tomorrow. Instead, he's drawn to businesses that have demonstrated consistent success over many years. And let's not forget about management. Trustworthy, capable management is a must in Buffett's book. He is a firm believer that the people steering the ship can make or break a company. So, if the management team has a history of wise decision-making and integrity, that's a big check in the pros column for Buffett. Business quality, therefore, forms the core of Buffett's investment decisions. And it's this focus on quality that has helped him amass his considerable wealth. The third principle of Buffett's long-term perspective is patience. We've all heard the saying, patience is a virtue, but for Buffett, patience is more than a virtue. It's a strategic tool, a cornerstone of his investment philosophy. Warren Buffett is not one to be swayed by the erratic ebbs and flows of the market. He doesn't flinch at short-term fluctuations or get caught up in the noise of daily market news. Instead, he remains steadfast and unwavering, with his eyes firmly set on the long-term performance of his investments. Buffett's patience extends beyond just holding on to his investments. It also plays a crucial role in his decision-making process. He's not one to rush into an investment. He waits, sometimes for years, for the right opportunity to present itself. He waits for a quality business to be undervalued by the market, for that perfect moment to buy. This ability to wait, to be patient, is what allows him to buy great businesses at a discount and reap the benefits in the long run. But patience is not about being passive. It's about being disciplined, about resisting the temptation to jump on every opportunity that comes along. It's about having the wisdom to know when to act and when to wait. Patience, thus, is not just a virtue but a key strategic component in Buffett's investment philosophy. The final principle in Buffett's long-term perspective is risk management. Now, this doesn't mean avoiding risk altogether. Instead, it's about understanding and managing risk. It's the art of balancing between opportunity and potential danger. You see, Buffett is no stranger to taking risks. However, he ensures these are calculated risks. He's known for his meticulous approach where he avoids investments he doesn't fully understand. This principle is aptly captured in his famous adage, "Never invest in a business you cannot understand." This helps him steer clear from potential pitfalls that are often hidden in complex investment propositions. But that's not all. Buffett is also cautious when it comes to debt. He appreciates that while leverage can amplify profits, it can also magnify losses. He thus avoids companies with high levels of debt, especially those that cannot generate sufficient profits to comfortably service their debt. Moreover, Buffett's risk management strategy extends to diversification. He believes in not putting all eggs in one basket. He spreads his investments across a variety of sectors, companies, and geographical regions, thereby reducing the impact of any single investment going south. In essence, risk management is not about being risk-averse. It's about being risk-aware. It's about making informed decisions, gauging potential downsides, and taking calculated steps. This strategic risk management approach forms the bedrock of Buffett's long-term perspective. In conclusion, Warren Buffett's long-term perspective is about much more than just holding on to investments for a long time. It's about recognizing value where others may not, appreciating the quality of a business and its potential for growth. It's about patience, waiting for the right opportunity, and managing risk effectively. These principles have guided his investment strategy, helping him navigate the volatility of the markets. Indeed, it's this long-term perspective that has helped Warren Buffett become one of the most successful investors in history.